Hello and welcome to this special series brought to you by Bombay Stock Exchange Investor Protection Fund and the Money Mile. Joining me today is one of India's best known financial planners, Shweta Jain. Thank you very much, Shweta. It's always a pleasure talking to you. You know, while a lot of people are very worried about their investments, we still keep seeing data that suggests that people are buying mutual funds. And I think the big question in everybody's mind when it comes to buying a mutual fund is, how do I pick the right mutual fund scheme? What are the 2 or 3 processes or steps that you would like to share with our viewers in terms of how can they go about getting the right mutual fund scheme for themselves?
Thank you for having me, Vivek. It's always nice chatting with you as well. When we are choosing a scheme, there are lots of things that you need to factor in, some more internal than external. So for example, you have to identify your time horizon so that it matches the type of scheme that you would want to invest in. You have to look at the risk profile that you can tolerate, how much risk you can tolerate, and then choose a scheme that matches that risk profile. Now, this second step is easier said than done. But we'll look at a few steps which will help us sort of identify the right scheme. Look at the fund house pedigree, look at the fund manager pedigree, how frequent are there changes in the scheme with these aspects. One of the things that of course is not proven is the size of the fund. The larger it gets a little difficult for the fund managers to manage and create that extra alpha for which we are investing in mutual funds. One of the things that investors should definitely do is identify whether they want to look at risky or growth assets or safe assets, because mutual funds do provide both options. So once they've identified their time horizon, for example, if it's only 3 years or lesser, then there isn't a point that they get into equity. They should look at debt or maybe maximum hybrid funds. So when they look at, say, for example, more than 5 years, they can look at equity for growth. Then they can look at things like rolling returns and not point-to-point returns. They can break them even calendar year-wise so that they can see how it's sort of broken down. One of the other things that they can see, for example, in a scheme is how comfortable are they with the securities that are being held in the portfolio. Because at the end of the day, a scheme is all that it holds, right? So they have to look at how comfortable are they with the names. One of the last things that they can see is what is the fund manager doing to get that extra alpha, is he investing in riskier assets? Is he going outside of the mandate? So there are a lot of these things that they can see and evaluate which scheme would be right for them.
Thank you very much, Shweta, for joining me here on the Money Mile and sharing your thoughts on this very important series where we seek to educate investors about how they can go about their investing behavior. Thank you very much.
Thank you, Vivek.